Hello, friends. Have you heard the latest news about the Federal Reserve? Brace yourselves because they are expected to hike rates one more time. Yes, you heard that right. The Fed, the central bank of the United States, is going to raise interest rates by 0.25% at this week's policy meeting. Hold on to your wallets, folks, because borrowing rates are already at fresh highs, and it's about to get even higher. You might be wondering, what does this mean for you? Don't worry, we've got you covered. Here's a breakdown of how the Fed's moves have been affecting your monthly expenses and savings. But first, for the love of God, subscribe and hit the like button. Now let's dive in. First, let's talk about credit cards. If you're one of the many Americans with credit card debt, well, bad news for you. The average credit card rate is now more than 20%, an all-time high. Thanks, Fed. You might want to consider canceling your plans for that dream vacation you've been eyeing because it looks like you'll be paying off your credit cards for a while. Now, on to mortgage rates. Anyone shopping for a new home has lost considerable purchasing power, partly because of inflation and the Fed's policy moves. The average rate for a 30-year fixed-rate mortgage currently sits at 6.48%. Your dream of buying a house might be just that, a dream. If you're planning to take out an adjustable rate mortgage, well, good luck to you. These rates follow the prime rate, which means when the federal funds rate rises, so does the prime rate. You might end up spending your entire life paying off your mortgage. If you're planning to buy a car, be prepared to shell out more money than you would have a few months ago. The price for all cars is rising, along with the interest rates on new loans. The average rate on a 5-year new car loan is now 6.58%. Keeping up with the higher cost has become a challenge, with more borrowers falling behind on their monthly loan payments. Good thing you've been working out your legs because you might end up walking instead of driving. If you're a student, good luck. Federal student loan rates are already near 5%, and any loans disbursed after July 1st, 2023 will likely be even higher. Private student loans tend to have a variable rate tied to the LIBOR, prime, or treasury bill rates. So as the Fed raises rates, those borrowers will also pay more in interest. How much more, you ask? Well, that varies with the benchmark. Congratulations, students! You might end up paying off your student loans until your hair turns gray. But hey, it's not all doom and gloom. If you're lucky enough to have savings, the yields are tied to changes in the target federal funds rate. The savings account rates at some of the largest banks are currently up to 0.39% on average. Woohoo! You might not be able to afford that vacation car or house, but at least you'll earn a few cents in interest. All jokes aside, it's no laughing matter that consumers are now paying more to borrow and have a higher cost of living. The Fed's rate hiking cycle is cooling off inflation, but higher prices are causing real wages to decline. Incomes aren't keeping pace with inflation, causing household budgets to be squeezed. People are racking up debt, and that's troublesome. In short, the interest rate hike by the Federal Reserve is likely to impact consumers' monthly expenses and savings in many ways. Higher interest rates lead to increased borrowing costs for credit cards, mortgages, and auto loans. However, those with savings accounts and deposits may benefit from higher yields. Remember, it's important to manage your finances, budget wisely, and consider how changes in interest rates may affect your overall financial well-being. Just know that you're not the only one struggling to keep up with these economic changes. We will get through this together. If you enjoyed this content, please comment, like, and share. Also, subscribe and hit the notification bell so you don't miss our Friday series on the steps to achieving financial independence. Thanks for watching.